Good day, everyone. Michael Brohan from ITM 21st here, and thank you to everyone for taking part today in the first CE session of 2018. Today's session has a one-pager with bullet points that can be found on our website if you do not already have it. If you have any questions during the session, and I hope you do, you can type them into the box and we will get to them by the end of the session. There's a chat box you can type your question into. Please do reach out if you have any questions. Before we get started, let's take a look at the next two sessions that we have scheduled. On March 20th at 2 p.m., Barry Flagg and I are going to talk about the purchasing of permanent life insurance and the process that goes on behind it. And you may think that the process is very simple, but there's a lot that goes into the successful selection of a policy. And after that, the underwriting, the process for underwriting, which needs to be understood, because policy costs are often determined during that underwriting process. And we'll walk through the entire process from beginning to end. I found that among trust advisors, there's a lot of misinformation about the whole policy sale process, which is why we put that course together. Then on Tuesday, April 24th at 2 p.m., Kim Nadovitz from Tribridge Partners will be here. Kim's an expert on long-term care, and this is a real hot-button topic today. If you've seen the articles in the Wall Street Journal, you know that the pricing has increased on some of these long-term care policies, and yet your clients need to be covered, as a long-term care issue can wreak havoc on their retirement funding. So this session is going to teach you the tactics that will allow you to reposition and repurpose monies for your clients to help them shelter their assets from long-term care expenses. But today we have John Mendelson here, and John has done some great sessions for us in the past, and we appreciate it. Today he's here to talk about life insurance policy valuation. John is a co-founder and CEO of the Asher Group and has been an advocate for best practices and transparency in the life settlement industry for years. He works closely with people like yourself to maximize the value of life insurance policies. He's constantly presenting to professionals across the country, and we're happy to have him here today. So take it away, John.
Well, I appreciate it, Michael, and thank you to ITM 21st for having us contribute today. As we go through this information, I would encourage you to ask some questions or certainly connect with us after if it's more of a specific client fact pattern that's going to take a little bit more conversation going through this. So what we're going to do is we're going to jump right into it and really just start talking about how do you determine what a policy is really worth. And that couldn't be any more critical than what we're seeing right now with tax reform and clients trying to determine, how should they take their available liquidity on an annual basis and allocate it? Should it go into their planning, their AUM? Should it go into their other types of assets or allocations that they have? Well, life insurance can certainly take up a significant amount of their available liquidity. And with changes in the exemption and other things that we're going to discuss today, there might be an opportunity to really reposition those life insurance assets or reposition those premium obligations that they have now into other areas of the plan. And I look forward to going through some of those examples today. One of the biggest questions asked in determining what a policy is worth is, what are the factors that take place? We certainly understand prior to that first premium what it's worth, and we understand when the insured passes what it's worth. But what's it worth in between? That's where that question really is. And what factors really influence what that value of the policy is? If you look at traditional methods and historically, you could have two exact of the same policies, as you can see here, Company A, so that's just one insurance carrier, and Company B. And they're $10 million policies. They have the exact same premium. But historically, if you were to find out what it's worth and you work with different estate planning professionals, they might say you look at the Form 712, see what the ITR, the interpolated terminal reserve value is, and that might tell you what it's worth. But it's not uncommon to see exactly what you see in this slide. Two policies with the exact same death benefits, similar premium, rated exactly the same, and they come back with different values. So that becomes confusing. And from a planning perspective, what do? How do you tell your client that this policy is worth, much less or much more? So some of the factors we're going to really get into today are going to change how you view how to value a policy. We've been asked to present about this and write about this, in all different types of publications, from tax professionals to estate and charitable planning all over the country. And this is something that can become a hot topic because it does involve such a large allocation of your client's available liquidity that might prevent other types of planning needs from taking place. If you just look at what the IRS says, what's a policy worth? What's any asset worth? It's really worth fair market value. What is a willing buyer, willing seller? And I won't read this all the way through to the end, but what is that asset worth? And if you were to look at any other asset class, you would typically say, well, gosh, we can get it appraised or valued. But at the end of the day, putting it on the open market, you'll really be able to know what that value for that asset is. Well, life insurance may not be that different than any other asset. It's just today considered a hard to value asset as an intangible piece of property. We started really focusing on this issue, back in 2010 and been working towards, where we are today, because this became such a confusion point for fiduciaries, and they would literally get stuck, and we would see them frustrated because they had client meetings, client planning discussions, and how in the world are you able to really determine what a policy is worth when all of their clients weren't the same, their health wasn't the same, the way they funded policies weren't the same, their planning situations weren't the same. So we started really getting down to this willing buyer, willing seller model and being able to look at real-time comps. So no different than if you were looking at the value of any other asset, you could look at market comps. Well, we had reviewed and valued a few billion of this. So we're talking thousands and thousands of policies, so we could start really seeing some patterns and starting to understand what the criteria is that would make one policy more valuable than another based on its fair market value as of today. Once again, not that future death benefit. We know what that is down the road, but as of today. So as of today's date, what is that policy worth? Is it worth the cash value, or could it be worth something much different? Well, one of the challenges that we came in, and this became also a pretty important factor that really changed the game on how you value a policy, dealt with longevity. And we recently finished a 3-year study with Columbia's PhD program in finance at the impact of wealth and even life settlements, specifically that cash event, that windfall on life expectancy. We looked at thousands of lives, and we looked at what would happen with each of those clients after they have a windfall. So it was really interesting data. What this picture really tells you is what many of you would also already know, that if you look at a mortality curve, wealthier clients tend to live longer. They on the longer side of the curve. They have access to better health care. They're typically highly educated. They don't really care who's on their plan. If they live in New York, but the specialist for their specific issue is in San Diego, they'll be in San Diego, and they probably will be there sometime within that next few days to next week or so. So it's really a factor that became the #1 pivot point on what a policy could be worth. So if you're looking at how much do you pay, and then you have to figure out how long do you project to pay it, you no longer have to only look at standard mortality tables that do not apply to your client, to that specific client. So it's a game changer. Anytime you're valuing an asset, you always want to know, how much do I pay and how long do I project to pay it, so you could present value determine what it's worth today. Many times, this can be good news or bad news, depending on the planning situation. If you're looking at that first example I had that dealt with the different 712 ITR values, well, gosh, if that's a really healthy client, maybe it's not worth as much as that 712 or ITR value. Maybe it's worth what the cash value is, or the basis, the premiums paid into it. There's other factors that you would have to clearly demonstrate and model out. However, understanding this longevity data point really could change the name of the game. If you had a policy that had very little cash value, but turns out the client, they had a much more compressed longevity, well, then the present value for that policy might be worth a lot more than that cash value. And we're going to go through some examples of some of these types of things today. But most importantly, for those of you on the call that are fiduciaries, what we connected the dots on, that a documented yes and a documented no will protect you. And from a transparency perspective, it's important to be able to let your clients know what their assets are worth, and if they're throwing good money after bad, if a policy is meeting its focus and its purpose that it was originally put in place. So these are all types of things, but there's nothing more powerful than something contemporaneous, that if a policy was lapsed and you're the trustee for a policy, and one of their beneficiaries come back to you and say, I have a question for you. I read this article or saw this commercial or advertisement, and it said a policy could be worth more than the cash value. Did you have anything that you could pull out of your client file that said, actually, we did explore this, and it was not worth more than the cash value at the time? Would that protect your E&O, your liability from a risk mitigation standpoint, or even your reputation? Being able to show that you went above and beyond. So a documented no could sometimes be just as powerful as a documented yes. And understand this, as we're going through this type of valuation discussion, firms like mine and many others, we do not sell life insurance. We do not manage assets. So this is not a unique marketing message. So we could do a competitive analysis and consider looking at new life insurance coverage. That's not what we're talking about. We're really talking about a pure mark-to-market on the insurance assets. So let's go through a couple quick examples. We already talked about one when they were considering looking at the 712 or the ITR values. Here's another that we worked with. It was a $10 million policy, survivorship, very healthy clients at age 74 and 68. Well, when they look at this, they had paid about $2.1 million into the policy. Their surrender value was $838,000, and they called the carrier to see what the ITR would be, and it came back at $3.5 million. Well, looking at that and looking at their customized, their personalized longevity data points for the male and the female, in order for there to be a fair market value in excess or at $3.5 million, they would have to have significantly compressed life expectancies, because within this valuation data point, we're going to look at everything. So our determination was at most it could be worth that cash surrender value. We leave that to the attorneys and the other estate planning professionals to rely upon their own planning recommendations and to use these types of data points for the, in their studying of what should be appropriate for the client. But what's interesting to know is that 712 value is truly agnostic. It doesn't have any idea about the health or the longevity for your client. So there might be an opportunity to have a more advantageous, customized type evaluation done that's a little bit more appropriate or realistic. But that's really for the estate planning advisors to consider as they work through this process. We're published in this month's Trust and Estates magazine, that you can take a look at this a little bit deeper, because this has become a very interesting and compelling topic that can have a very large 6 to 7+ figure impact on estate planning with different types of clients. But our experience is that planners and fiduciaries are searching for ways to get unstuck and to solve these types of problems, and we're hoping that this type of valuation consideration might make sense to them, just the logic behind it as well. When looking at any type of estate or business planning, the reality is that there's almost always some type of life insurance component in charitable planning. Whether it's a key person, buy, sell, you can go all the way around. There's obviously so many other areas of planning, but being able to have this valuation data point will uncover a lot of planning conversations and discussions about does this insurance still meet the current needs? Did it outlive its purpose? Let's talk about longevity. How do we know how long to fund this? What makes sense for this specific planning situation? So it really does open up a lot of very interesting conversations, and it's a great way to have discussions with not just G1, but also the second generation, and bring those adult children into the conversation. A policy might be running out of account value or cash value, and significant premiums are going to have to be paid. Maybe that's a time to bring in the adult children to let them know that based off the personalized, customized life expectancy and longevity of their parent, they're going to have to fund this insurance contract different in order to maintain it, or what other options could exist. So one of the more common that we see, and this is a daily type of phone call, is there's been a reduction of estate size. They no longer need as much coverage for planning purposes. And in this, we had a $4 million policy. It was a survivorship with one deceased. It was a premium that was very significant to this family. So instead of spending almost $300,000 a year for this policy, they're trying to determine what their best options are. They could just cash it in for a little over $100,000, but it's a little bit frustrating because they had spent so much money over the years and it just didn't quite feel right. Well, we went through this process of looking at their longevity, trying to determine what the value of this policy would be based off all of these premiums, and there ended up being a fair market value of $1.55 million. Now, how in the world could that exist? You have a surrender value of $109,000 and a $1.55 million fair market value. We're going to talk about what that looks like now. And we're not going to spend too much time on this, although this could certainly be an entire presentation in itself. When you're looking at how to determine the fair market value of any asset, you would put it on the open market. Well, fortunately today, 90% of the population lives in a regulated state for the life settlement and the secondary market. And that's really been a game changer in determining the value of a policy. It's no longer just a cash flow analysis. It's no longer just discount rates and looking at what this policy could be worth based off a standard male or female at a certain age. In this situation, we had, maintaining all types of HIPAA and privacy requirements that take place. The policy in a secure type of bidding auction was put in place with all these regulated parties that purchase policies. And I'm going to talk about what some of those types of companies look like. These are not individual investors. And a competitive bidding situation to determine what that fair market value was for this policy took place. There was lots of bidding. There was back and forth. No different than if you were selling your home or if you imagine at a Sotheby's auction. At that point, the value to the client continues to rise with increased competition until in this instance, it topped out at $1.55 million. So you can tell from this amount of continuous bidding and competition that fair market value, willing buyer, willing seller, really took place compared to someone just kind of throwing in the towel and just cashing it in for the $100,000. As a fiduciary, imagine this was your client. Can you imagine the conversation if they would have left north of, obviously 7 figures on the table? It's a really interesting type of situation that those of us within this market work on every day. This is not the exception. This is the rule within the secondary market when you're matching willing buyers and willing sellers. So just giving you a kind of macro view of what the organizational structure looks like, you can see with that line down the screen, on the right side of the screen, you have all of these types of buyers. Notice these are not individual investors. This is not that type of market from 20 years ago. This is a market dealing with the top private equity, pension plans, endowments, really sophisticated capital markets that see this as a non-correlated asset class. In fact, some of them are even reinsurers that have they had $1 billion block of mortality risk. How do you hedge that? How about $1 billion block of longevity risk? On the left side of the transaction, you see all of those that represent the client. These are individuals that have 100% responsibility to the policy owner. They're working on behalf to make sure the client is best positioned. They win and their interests are aligned when the client when the client has the best solution they can have. So those on the right side of the transaction, these are not malicious players. They are not opportunistic. They're simply the willing buyers. And their responsibility in this transaction is to abide by all applicable rules. This is a highly regulated transaction, as I talked about. And to really, at that point, provide their best bid, their best offers, so this client can receive that type of fair market value. There's all types of players that have been in this market. I'm not going to spend too much time on those, but it's really the who's who that have been with within the capital markets, both domestically and globally. Another common example we have is in business planning. And this was a really interesting fact pattern. There was a corporation that was being purchased by a private equity firm, and they had 4 policies on the balance sheet, totaled around $12 million. They no longer needed the coverage. The executives, the insured, were living longer than anyone had ever projected, and frankly, they had lost so much of the cash value over time because they never projected continuing paying premiums so late into their 80s. It was unbelievably tight time frames because this transaction was closing about less than 6 to 8 weeks later. So we had to really move fast on this. And to look at this type of market-based valuation, we looked at everything from the health of the insured. We looked at the policy data. The client is never examined. There's nothing like that. It's not invasive at all. It's just collecting records and abiding by all, once again, HIPAA and privacy laws, and then looking at their longevity. We ended up being able to deliver, as you can see, $2.85 million. But what was so interesting about this was that this M&A firm had never even heard of this type of regulated institutional secondary market to determine the value of a policy. They had only heard about the traditional ways. What was the cash value in the contract? If you called the carrier and asked what the ITR or 712 would be, how about that? They had never really understood this type of path that could be taken. So they effectively left millions of dollars on the table for this. Well, can you imagine how many clients are valuing their businesses or have sold their company, or maybe they've dipped into cash flow to grow their business, and turns out they might have been able to reposition their policy, their existing coverage. And by the way, this also works for term insurance, which we'll get into some examples in a little bit. But when determining the value of a policy, it's not just at face value, and it's not just that surrender value. Another very common situation is a term, as I just described, but they're typically convertible term policies. If they're not convertible, then there has to be a significantly compressed life expectancy. And at that point, the client should truly consider keeping the policy if that client really does have a compressed type of longevity. In this, they were simply about to let the policy go for zero. And as you can see, the policy was worth almost a couple $100,000. So the big takeaway and practice tip is, do not lapse a term policy without having it valued. It might make sense for the client to keep it and convert it. It doesn't mean that the answer is every time the client should potentially sell the policy. They might keep it, they might distribute it out to the partner as some form of a buyout. Maybe they're buying out a senior partner, and they can buy out this partner, in this example, for $195,000 less. So there's all different types of ways that understanding what this data point is can influence business planning. As you go through this, let's talk about charitable planning. As I mentioned, many times there is a life insurance component to charitable planning, although our experience is most charities view life insurance as almost secondhand smoke that they're forced to interact with. They would much rather have cash, equities, anything else but life insurance. They're hard to manage, it's a little bit confusing, and they're pretty high maintenance. And once again, they don't see the benefit for years to come. Well, in this example, there was 2 policies for $1.5 million, and the donor was simply outliving the gift. And one of the major issues they had was the tragedy of the client not seeing their gift realized, the charity not receiving the $1.5 million. However, as you can see, the benefit, we end up going through our process of this willing buyer, willing seller, and delivering over $500,000 to this charity that was going to be surrendering these policies for less than $25,000. They're able to honor the donor while they're living. Their children and grandchildren were able to see them being honored. They were able to see how the money was being used. So once again, if the funds that are purchasing policies in this space see value in these contracts, so should your client, and the client should consider keeping the policy. The main difference, and this is really important, the main difference is that these funds have a law of large numbers on their side, and your clients might only own a handful of policies at most. So if they're wrong, they're still left with a couple policies that they have to deal with and continue funding. Maybe there's cost of insurance increases, and now they have that one of their, two policies they own might become unaffordable. There's so many things to consider, but the funds in our space, they might even lapse a policy if the policy is underperforming or the cost of insurance increases. So this law of large numbers is really the key takeaway on why clients can benefit from the secondary market, but why they also are playing by a different set of rules than these large funds that own larger portfolios of policies. You wouldn't be considered a diversified real estate investor if you own 2 or 3 properties compared to a real estate holding company or a REIT that has hundreds to thousands of properties. Another common example are policies sitting in trust that truly just haven't been reviewed in years. Sometimes the agent that wrote them is not still active, and that has become more common that we've seen over time. So as you look at that, and it's not uncommon to see the cash value that's eroded. And then you have a surrender value on this example of $34,000. So now they're trying to determine what are our options? What should we consider doing in moving forward with this planning situation with this client? Well, the secondary market produced $125,000. So once again, I ask you, as we go back to a documented yes or a documented no, imagine if this exact same situation, there was zero offer. The secondary market did not respond, and the best that the client could absolutely do was the $34,000 of the surrender value. It's still a positive conversation for the client for them to know that they did not leave any potential capital or liquidity on the table. And it's powerful for you to have that conversation because once again, reverse that situation. They surrender this policy for $34,000. They then have a second policy that's a similar policy. You become aware of this option. You then explore the market, and then they realize that they were able to receive $125,000. And now their concern is, well, what about the last policy we just let go? Was this market not around? Was it not available? So it now puts you in a situation where what I'm hoping happens is that you take this information, this knowledge point, and when you go back to your companies, you go back to your teams, if you're part of an ILET team or some other type of planning team, that you really take a hard look at the policies you have and start really thinking about, should these policies get valued? We don't want to take the chance of any of these lapsing under our watch that could be worth significantly more. So as a practice tip here, we'd encourage you to bake into your planning process periodic reviews or valuations of these types of policies. It's critical, and not only from a risk mitigation standpoint, but also to help grow potentially the assets of your client. Imagine if you had a policy and that was sitting in an ILET, and that's the only thing in the ILET, which we see all the time. Maybe you're working with the matriarch and patriarch of the family, and frankly, you don't have a relationship with the younger adult children. And you go through this process and you see a policy that maybe it's a couple $1 million policy, very low surrender value, and they're a little bit frustrated because now premiums are due, there's very little cash value whatsoever, and you discuss this opportunity of being able to value the policy. And now one of the options that the adult children can have is to keep the policy, maybe pay that escalated premium to keep the policy in force, or you could look at valuing it and potentially monetizing it and get a windfall to the trust. And what we're finding is that many of the fiduciaries and the trustees that we work with, it's a really interesting type of conversation. Many times the clients really don't understand the level of diligence that you're doing on a daily basis and all throughout the year. And to be able to really demonstrate to them that you are paying attention, you are spotting issues or potential opportunities, and in an instance such as some of these examples I went through, being able to generate a windfall for the family that really brings in that second generation into the conversation, that might be a great way for you to add value, to differentiate, and then now maybe even have some assets to manage compared to just the liability of this life insurance policy that was sitting on the books. So which policy is worth more today? If I said to you, there's two identical $1 million policies with the exact same rating, same premium, same cash value. Now we're sitting here a little bit into this presentation, and compared to where you might have started by looking at, well, gosh, I guess they're worth the same, or we know what they're worth when the insured passes. And maybe if you called the carrier and said, what would that ITR or 712 value be, they could be a little bit different, but what's it really worth? And hopefully this longevity data point would really be the game changer in understanding that. Because if you imagine one of these $1 million policies had an extremely healthy 70 to 75-year-old, and they were working, they're traveling, they're living independently, they're involved socially, so they're just really in great shape. Maybe they have normal age-related impairments for anyone in that age, but as a whole, they're doing really well. And then you look at another individual, or excuse me, that same individual with the exact same policy, same face amount, same ratings, and on, but they had significant health issues and they weren't working. Maybe they're having a hard time managing their health issues through medications. Maybe they needed a lot of assistance with their activities of daily living. Well, if you look at those two $1 million policies traditionally with standard methodologies, you'd say, well, gosh, same face amount, same rating, same premium. If we look at a mortality table, then the policies would both be worth probably around the same thing. Well, now with this longevity data point, you realize that each of those policies could have completely different values. One might be worth nothing more than the surrender value, and one might be worth 5, 10 plus times that value. So I'm hoping this really opens up your mind to have those types of conversations. Many times we're asked, so just give it to me straight. Who's the ideal client that really impacts what a policy could have more value than the cash value in the contract? So what we've done is we've outlined that all types of policies can have additional value than the surrender value in the contract. The secondary market, which is a highly regulated space today compared to 10 to 15 years ago where it was not as regulated. But as I said earlier, 90% of the population lives in regulated states. Over 100 billion of policies, including term, lapse every single year, and that was billion with a B. So you're talking, 500 plus billion over the next 5 years. I mean, can you imagine the type of pressure you could take off some of these state programs, some of these adult children and others that are financially responsible for caring for a lot of this aging population? We by no means in this market are the silver bullet. However, we really could be just the right solution at just the right time. Coming back to the ideal client, all types of policies can work. Low cash value is typically more attractive. The funds we work with have anywhere from hundreds of millions to billions to deploy. They're not looking to purchase cash value. That's why whole life is typically the least purchased, and in a renewable term also because it's just an escalating type of premium. Policies that go beyond 100, with so many clients living much longer than ever projected and well into their late 80s and 90s, they want to make sure that they're still maintain the death benefit. All types of ages can work. Ideally, it's typically someone with around that 15-year projected life expectancy. So if they're 50 to 60 years old, then they're highly impaired and they have a lot of health issues. Once again, everyone should always consider keeping a policy. Just because the secondary market, when valuing a policy, thinks it's worth a lot more than the surrender value, doesn't mean that they should sell it. They might decide to keep it. They just, once again, don't have that law of large numbers that the funds that are within this space have. So policies that were issued standard or preferred, that there's been a change of health. So now you have this mismatch in cost and premium based off where their health was then versus where it is now. So that is obviously a huge factor. If you have two $1 million policies on a 75-year-old male, one was issued Table D, which means it was a much more expensive premium, and the other was issued preferred when the policy was issued, which is a much less expensive premium. The economics, when the valuation takes place, is going to have a completely different outcome. So having a policy with that mismatch, that health arbitrage, from the time the policy was issued to where it is today, is another key data point as we go through this process. If I was to say, let me just make this easier for you to start the conversation. So if you're meeting with the client, whether it's this week, next week, maybe you're adding to your discovery or your fact finders that you have with clients, and you write down life insurance assets, date last appraised or valued, something that really just opens up their mind that this is a piece of property, it's an asset. And one of the most attractive reasons about this asset is that it's transferable. You can assign it, you can gift it to your alma mater, to a religious organization, to a business. The banks many times might use it as collateral if you're taking a loan to grow your company. It's an asset. It's a piece of property and has all the property rights associated with any other asset. This is something that many of these clients paid significant dollars to, over a multi-decade period of time. So this is something where you can really solve some pretty interesting planning situations by repositioning these types of insurance assets, regardless of the cash values within the contract. When we do these types of presentations around the country, we also have ways of looking at it from a compliance perspective and other types of more CE based off whether you're a tax professional, a trust, legal, in that whole world. We encourage you to really ask good questions, connect with us on LinkedIn, Facebook, Twitter. We do a lot of regulatory updates, also different industry updates that might impact your planning. But most importantly, talk about this with your teams. Add that longevity question. Ask your team who's responsible for appraising or valuing these types of assets. If you don't have anyone that knows how to do that, or they're looking for ways to solve that, then there can be many options to explore. And frankly, you're sitting on what could be some really game-changing types of planning discussions with your clients. Some of the common questions that are asked, and then I'll turn it over to Michael. But some of the most common questions is how long does this process take? And one of the initial screening, just to determine, does this even make sense to explore this further? That really can take week one. All you really need is some basic life insurance information, some policy information, date of birth of the client, just some of the basics. And anyone that's an expert or specialist within this space will be able to give you an idea if it's worth digging deeper. Every state regulates this individually. There's state-approved forms that have all the reps, warranties, disclosures. So if the insured lives in Georgia, but it's a trust-owned policy in North Carolina, then the documentation, the paperwork is all predicated by the state of the policy owner. So you would look at North Carolina forms. Sometimes we have people ask us, well, gosh, it's interesting, but when you talk about these willing buyers, is that an awkward conversation with the client that even if it's an institutional fund, they could be owning a policy on the life of their family member? And what we always talk about, because we've been working within the high net worth space for a long time, is that many of your same clients will donate a policy, to University of Michigan or to another cause that's important to them, and they're not concerned about that. And I know, and people sometimes will joke around about this topic, but if you look at long-term care, you look at life, annuities and lifetime annuities and all these different types, no one's concerned that the insurance carrier would, gosh, they have this policy issued on me as the insured, and would they prefer that I live to 75 or to 95? So there's a lot of longevity-based assets, life contingent assets that you will continue to see. We have a third of the population moving into this demographic, and there's a second third that is being forced to fund the caregiving and long-term care needs of that generation. So this is going to become a bigger issue, a bigger opportunity for you to have with your clients every year, because there's a significant amount of of clients who have never had this conversation. It might be brand new to many of you today. Michael, I'm gonna bring you on.
Sure.
I know there could be additional questions as well.
Yeah, there are. We have a couple of questions. And first of all, I just want to jump in and say, certainly ITM 21st is bullish on the trust-owned life insurance marketplace. We must be, because we started a trust company focused only on that asset. But we also don't live with our head in the sand. And we know that with the tax law changes, there might be reasons for policies to be moved around. That's one of the reasons why I wanted to bring John in to talk about this, because policy valuation is important. The first question we have, John, and I have a follow-up, is if you could talk in more detail about what the 712 value of the ITR is and why it might not be the correct value.
Sure. Well, 712 and the ITR, the interpolated terminal reserve value, was really put in place for whole life and annual renewable term, literally 40 to 50 years ago, before the invention of modern day products, universal life contracts, and all of these different types of contracts, where it becomes simply confusing for non-insurance professionals to know how to really, how they operate. There's all different types of levers within those contracts. Well, the ITR and 712 values were pretty darn accurate when you're looking at a whole life policy or different types of term contracts. And you would look at it and they'd look how much premium had been paid. They'd look at the different rates within the contract, the cash value, and they go through it. And it was a pretty darn, on target type of value of what it is. Well, the problem is those became, that type of interpretation does not apply to modern day products. And now all of those issues started to arise that we went through today.
So let me ask you this, the 712 versus fair market value or some valuation that you come up with, is there one that takes precedence, or is this just something that, it's up to the facts and circumstances and the advisors to determine? If you have a value that's much higher or lower than the 712, how does that work, John?
Yeah, it's interesting, because if you request a 712 from a carrier, many times, and we've seen this with probably a dozen different carriers, they will show 4 or 5 different values, and many of them have nothing to do with what the fair market value is. It's here, this is our reserve rate, this is our credit. They go through four or 5 different values, and then they add a note at the bottom that says, if you have a different methodology for determining the value of the policy, prepare to demonstrate, defend it, things such as that. So there's some hard and fast rules. As far as I'm concerned, with whole life and policies such as that, it's really difficult to use anything but the 712 ITR values unless they're highly impaired. And if they're highly impaired, then it could be even greater than that number, which
Sure.
may or may not be advantageous for the client. But as a whole, it's really a question mark that we're seeing all across, all around the country when we have these conversations.
Okay, so 2 questions then. How has the change in the tax law affected, the number of people calling for evaluations, or a number of people calling just to see what the value of their policy might be in the secondary market? Are you seeing an uptick already, or advisors reaching out more often?
Yeah, absolutely. Because with changes in the exemption, we've seen so far, north of a 20% increase since January, since this happened. And what's interesting is within that conversation, there's a lot of sidebars within that whole conversation, because if a client, due to changes in the exemption, can really free up a lot of liquidity for charitable planning that's been very important to them, what an amazing way to reposition their insurance assets that served their purpose already, and they no longer need them at the level that they had. But at the same point, we'd also caution people, just because the exemption is different today than it was, prior to 2017, it doesn't mean that it's not going to get the sunset. We're talking 2025. They might need that coverage, and they may not be able to get new coverage if they have health issues. So if you have your your insurability locked in, you may not want to transfer, sell a policy. You might want to keep it because there's no guarantees it's not going to come back. What was really interesting for the first time since 2009 was there's a revenue ruling 2009-13, and that completely changed how the taxation of a policy in the life settlement market. So if a client was to sell a policy back then, there was a really confusing and almost convoluted formula that they would have to go through, where there was zero tax up to the adjusted basis of a policy, and that adjusted basis was really the premiums paid less the cost of insurance charges, and the carriers wouldn't necessarily give you those cost of insurance charges, so you'd have to do your best and a lot of CPA hours and billing to the client to try and determine what those underlying cost of insurance charges are. Because the reality is they can swing from 80% from one side to the other, depending on the product and the carrier. Anything above that was treated as an ordinary income, and then a long-term capital gain above that. Well, now with the revised revenue ruling 2009-13 that just came out in the new tax reform, there's zero tax up to the basis, so the premiums paid into the policy from the basis to the surrender value treated as ordinary income. Everything above that, a long-term capital gain. So now it's treated no different than a surrender. So no one's being discriminated against for selling their policy compared to surrendering the policy. It's a much, we believe it's a much fairer way. We work with all different types of fiduciaries that feel the same way. It kind of confused them because they were asked to identify information that they frankly, weren't able to obtain. So it was pretty darn confusing. So this is a huge win for consumers, for those that are looking to find ways to fund their caregiving, their long-term care, their home care, whatever it is, maybe their lifestyle, because they're going to be able to have more money and keep more money in their pocket than the way the past revenue ruling was.
Yeah, it was wonderful to see, not to get political, but it was wonderful to see the government not only make it so you could keep more of it, but just make it simpler, because it's pretty crazy to have to go back and try to figure out what the cost of insurance was on a policy that you sold. It's pretty darn hard to go back and do that. So it makes it, not only are your trustees' clients, if they wanted to sell a policy, able to keep more, it just makes the whole process a lot easier. Last question, John. I know that obviously John's in the life settlement marketplace, so if trustees have a policy they think is something, a grantor is interested in maximizing the value, getting more than the surrender value, et cetera. Obviously, you can pick up the phone and call John about that. What about just, I want to gift a policy and I want to find out the true market value? Is that a service that's out there? Is that something that you do, or is that something that can be done out there?
Yeah, absolutely. Many times people aren't looking to fully monetize it. They just want to know what it's worth, whether it's for gifting, transfer, distributing out from a corporation, and that's something that we can help with as well with our certified valuation specialist that we do have. So that is a common need, and once again, we don't, and the majority of firms within our market do not sell life insurance, manage assets. So it's not really, this is not a creative way. So there can be insurance reviews done with the opportunity to rewrite new coverage.
Right. Yeah. So, well, I appreciate you taking part today. Like I said, I mean, I do believe that obviously the TOLI marketplace is changing a bit with the changes in the tax laws, but I think that one of the things that's going to happen is we all are holding on to or managing or responsible for assets worth millions and millions of dollars. And we've got to figure out the way that we can maximize the value to the beneficiary. That's what our job is, no matter what happens with the tax law, no matter what happens with the grantor saying they want to pay a premium or stop paying premium. So, this is part of the reason why I wanted to have John on to talk about these things, because I think that if you're a trustee or an advisor to someone who has life insurance inside or outside of an ILA, a substantial policy, these are the kind of discussions that you may be having over the next few years. Both, as John said, on a number of occasions, that discussion on, hey, you should probably keep this. And part of that discussion part of the facts needed in that discussion is the policy valuation or what you can get in the secondary market. So I think it's just an important part of the discussions that everybody should be having. I appreciate you taking part today, John, and that's the last question we have. I appreciate everybody else taking part today. Thank you very much, John, and we look forward to having everybody join us in March when we have a discussion on purchasing life insurance going forward, purchasing a new policy, which I think would be a great session for anyone who is dealing with clients that are out there looking at purchasing life insurance. John, thank you again. I appreciate you taking part today. If anybody has any questions, you can certainly give John a call at the Asher Group. He's a great person to work with. He'll work on your side of the table, so to speak. So if you have a grantor or you have a client that's looking for either a valuation or possibly to sell their policy in the secondary market, certainly do give John a call. Thanks again, John, and thanks again, everybody, for taking part today. We'll see you in March.
Have a nice afternoon.
Bye-bye.